That's a little better. All right, big day, big day. We have the much anticipated Jerome Powell coming to speak live, as they do, announcing their decision on their interest rate changes. A few months ago, we watched it here, and the speech was a little hawkish. They were looking to increase rates by 25 basis points, I believe, 4 times into the end of the year. And today we will find out, as they stated, if they're going to be following that schedule. So first, I think we didn't do this last time. We'll do it this time. What is the federal funds rate? So the term refers to the target interest rate set by the Federal Open Market Committee, the FOMC. That's what we're going to be watching today. This is the target rate at which the Fed suggests commercial banks borrow and lend their excess reserves to each other. So this is not really something we see in our everyday lives. We're not banks lending each other money, but essentially banks are constantly, at the end of the day, settling up. Some don't have enough dollars, and the ones with an excess of dollars lend those out for a rate. Now that rate is a market rate, so the federal set rate isn't necessarily what they end up loaning each other those dollars for, but it gives them a guideline, and it in general is interpreted as a large signal to the market. So that's really what's more important here than the actual rate. Is historically we have seen markets respond to these rate changes pretty dramatically. So we could see something spicy here today. A big factor as well is more of how they schedule it. So they are setting themselves up for 25 BPS, which really is just fancy terms for 0.25% interest rate hike today. That's what the market expects, and that's what the market is likely factoring in, building in. So almost more important than how big of a rate change we see is, are they going to follow through with what they've laid out in the future? If they pull a wild card today, as I have been speculating, walking back their language, saying, well, we're going to wait. They may blame Russia. They may blame cryptocurrency. They may blame inflation. I've been predicting that they're likely going to walk back their really aggressive stance here. And that, if it happens, is going to cause a shock to the market. Markets, as I said, busy kind of factoring in, baking in this rate change. And almost anything other than exactly what they laid out is likely to have volatile consequences. So this policy-making body meets 8 times a year. We like to do them live here. It's fun. The talks themselves are very boring. They typically don't say much, and so we like to put a little spin on it, watch it together. We also enjoy having the Bitcoin chart up next to it, and in real time seeing how the market reacts to what is said, so that's going to be spicy. It's coming up here. We have 10 minutes until the notes are released, so I'm going to do my best to find the decision. It's really confusing. They release the notes at 2, and then Powell comes on at 2:30. So there's a 30-minute window in between where the FOMC has already released their notes on what they're going to say, and them actually announcing it live. Why? I don't know. No idea. I was explaining the interest change, though. So they meet 8 times a year. It's part of the U.S.'s monetary policy, and it's used to help promote economic growth. While the Fed, as I said, sets the rate itself is determined overnight by the lending market based on supply and demand. Kind of went over that already. The central bank may intervene in the open market to influence the rate if the market strays too much. So this is really policing of free economics. It's a little monetary control that is enacted by the Fed. So we call the rate set by the FOMC the federal funds rate. It's based on prevailing economic conditions. Sorry, you can't hear it, but my dog just all of a sudden started barking in the background, and it's throwing me off. Definitely can influence short-term rates on consumer loans and credit cards. So I think logically we can all understand that better than what's actually going on. If you have to pay a higher percent interest on your debts, you have less free money, less capital. If you all of a sudden pay less interest on your debts, now you have more free capital. So in general, that is going to be what actually affects us here. And on top of, as I said, geez, she will not stop barking. I wonder why. Man, that's throwing me off. I'll just get back right on script. By law, banks must maintain a reserve equal to a certain percentage of their deposits in an account at the Federal Reserve Bank. The amount of money a bank can keep or must keep in its Fed account is known as the reserve requirement and is based on a percentage of the bank's total deposits. Financial institutions are required to maintain non-interest-bearing accounts at the Federal Reserve Bank to ensure they have enough money to cover debtors or depositors, withdrawals, and other obligations. Any money in the reserve that exceeds the level required is available for lending to other banks that might have a shortfall. So that kind of wraps up what we were saying. This is mostly geared at how banks are operating intra or in between each other, but it does spill out into our everyday lives. As we can see, short-term rates change on consumer loans and credit cards, etc. I think that's decent. Interest rates serve crucial functions in a market economy. The most obvious is the coordination between savers and borrowers. Savers are paid interest, putting off their consumption until a future date, while borrowers must pay interest to consume more in the present. When there are relatively more savings and supply of loanable funds increases and its price, the interest rate should drop. When more people want to borrow than current savings can satisfy, the price of new money is driven up and interest rates should rise. That's all kind of boring. I'll throw this up here. This is the historical effective federal funds rate. Interesting note, this is data taken from the Fed directly, and I do believe it stops at 2020 in February. Pretty good timing. Some trickery has gone on with balance sheets and reporting data. I think it's all factual, but a little bit selective. So we can see that in the 1980s, the 80s, baby, interest rates were at 19%. That fell off through the decades. In 2008, those rates wound down to close to zero before rising slightly into 2017 and 18. And then, as we all know, they dropped them 2020 down to 0 to 0.25, which is essentially the lowest I think that they are happy being at. Though negative effective rates can be possible, we have not seen them. And so that's maybe a little spin today, is any reduction of an interest rate will put us at that zero or negative territory, which we haven't seen. Though I don't know if that's likely. That would be a very spicy setup. Very, very spicy. Something that's interesting, I stated that it's used to kind of tweak the economy, influence the markets. In general, when the economy is roaring, the Fed has increased or incrementally increased interest rates, and this is essentially to kind of put the brakes on an overheating economy. This is typical of monetary policy. However, after 2008, we saw that graph. I'm not going to pull it back up because I just closed it. While we did see them slowly crank rates back up, they never actually got back to really meaningfully high. And so now we're here in the midst of a potential recession, if we're already in one or not. And rates are at zero. So the Fed's in a really interesting spot. Inflation is hitting record highs around the world, and typically you'd expect them to increase rates to combat that. The problem being is if they do decide to increase rates, the markets are not going to be happy. Money will essentially become more expensive to borrow, and we may see the stock market take a hit. So the Fed's in a really interesting spot here today and throughout the rest of the year with balancing, do we want to save stocks or do we want to save the dollar? And as crypto people here, we know the answer that we want. We want them to save stocks and commodities. We want them to let the dollar drop. And obviously we want to see them pick up maybe crypto or Bitcoin. That might be down the road. But with the recent executive order, we are seeing U.S. politicians now with their attention focused on cryptocurrency for the first time. Executive order, in my opinion, if you saw my talk with Kevin O'Leary, very bullish, laying down the framework for cryptocurrency in the United States and institutional involvement. I think that's big stuff. People, half the crowd is like, man, do silly stuff again during the meeting. And then the other half is, don't do silly stuff during the meeting. I mean, this is going to be pretty boring. Typically, they don't say a lot. So, I mean, I don't care. I like doing silly stuff. I like to be sillies, but if you guys want to be serious, we can be serious. And by the way, Achilles, it actually, we won't have any live coverage until 2:30. 2 o'clock, though, is when they release the notes. So I'm checking my watch again, 5 minutes. We have 5 minutes. I'm going to do my internet scouring the best I can to see how quickly I can grab this information, get it to you guys. And then at 2:30, we'll listen in and we'll hear Powell speak. Fingers crossed, Gina is back, my long-lost love. Gina, you never replied to my DMs. It's okay, I forgive you. I fell in love in the last meeting. Gina, she's as smart as she is beautiful. I don't even remember who she is anymore. I just remember it was funny. I enjoyed it. So we have a poll going. We got almost 400 votes. 42% of us weighing in at the Fed's going to keep with policy at a quarter or 25 BPS rate hike. That's likely the most probable outcome here. It's not the one I'm rooting for, but it's probably the most probable. They did announce that this was going to happen, and that's what they were going to do. If you're just tuning in, I was saying how what's even more important really than what happens with the rate is what the market's expectations are. So because Powell set out and laid out such a detailed schedule, well, for the Fed detailed, the market since then has been baking that in. People, institutions are certainly looking ahead. They aren't investing day to day, making kind of whimsical choices. They're looking forward into the future, into the next quarter, into the next year. And when the Fed gives detailed language like they did, they're going to start adjusting their models based on that. They're going to start saying, okay, we're going to have to factor in 0.25% higher interest rates, etc. And so what's important is if they stray from that, they're going to be mixing up the market. They're going to be giving the market less confidence, I'll say. Less confidence in the future environment or the upcoming environment for investing in money markets, etc. So I think you're probably right, guys. Keep hitting that poll, though. Let's see if we can change it. Some people are looking for a higher interest rate hike. I think that would be interesting. I think that would be logical as we are seeing in CPI inflation numbers coming out higher than expected. It wouldn't be crazy to see them take a more aggressive stance. I'm not sure that's the probable move at this point. As man, that would be wild. If guys, here's like the TLDR. If anything other than 25 basis points happens, it's going to be interesting. It's going to be very interesting. I have the Bitcoin chart open here. We can see in 2 minutes, 10 seconds, I will start Googling. I already have my news sources pulled up. Actually, I lied. I'm doing that right now. Pulling up my news sources so I can refresh them. And actually, let me make sure I have a few more Fed rate hike. And we'll search by anytime past day. Okay. Have these pulled up, and we'll try to get the answers here to you guys as quickly as possible. We are live. It is odd to me that they do this. They release them to like news sources and then finally go on. But that'll be 31 minutes until we actually hear them speak. Bitcoin not really reacting at the moment. Let's actually pull up the chart here. Make it a little bigger. We're live from the newsroom today, so it's a little different. Let's put it on the daily. We can see today actually not looking terrible. On Bitcoin, we have a 3 candle potential bullish setup. We'll see in 6 hours if Bitcoin can close above 39.6. That's going to be looking decent. Let's add a little support line here. And let's even title it. There we go. 39,675 will be the daily bullish engulf line. That will be our target for today's close. A close above there is going to look pretty good. I'm surprised to see green before these announcements. Typically, we see mostly ranged or sideways trading. And in reality, that's kind of, that's what we've been looking at forever now, right? Pretty much all of 2022, we've traded in this tight range. It would certainly be, as you guys, if you're Crown followers, if you've been around, I have been prophesizing that Bitcoin is waiting for some kind of catalyst. A mix-up in the markets caused by the Fed. That could be the catalyst we're looking for. I've been kind of on the theory of, well, here we go. It's time to refresh. Give me a second, guys. I'm going to take a look, see if I can find anything published this minute. Latest news. Refresh. Bitcoin with a red candle. Not a big one, but a red candle with this news being out for 30 seconds. Am I gonna be able to find it? And you guys, do the Googling as well. Please do the Googling as well, and share here. Whoever finds the info first gets a gold star for the day. Let me see. Financial markets. Of course, now it's not uploading or updating. This little dump right as I was saying how surprised it looked decent. Great, thanks Bitcoin. News, latest news. Come on. Nothing yet. I guess they have. You'd assume they would just type out these articles in like every situation, right? Like for every outcome, and then just publish them right away. Typically, it takes a minute or two before we see news sources start popping up with the results. So far, I'm only finding that they have followed their plan, aka the 25 BPS rate hike. Using investing.com, you are not updating, my friend. Everything I've seen, I like to at least confirm it with multiple, like at least two sources before I declare it. But so far, all I've seen is the 25 basis points. I switched my browser and this thing is being weird. Yep, Bitcoin apparently not loving this news. Let's see. Have you guys found it? You guys found the outcome? Let me open this chat. Yep, we got a 25 BPS as expected. So this is not the shakeup that we could have had. Simply following schedule is likely the smartest move. And let's see, that would put, out of 508 votes, 44% of us correct. Well done. Pat yourselves on the back. Pat yourselves on the back because you were correct. We got 500 watching. Guys, if you haven't yet, smash that like button. The more likes we get, the more YouTube shows this live stream to new eyes. We get new fan members. Help us out. It costs you nothing. I appreciate you. If you haven't subscribed yet, please smash the subscribe button, enable notifications. We're live here with the cutting edge news, covering cryptocurrency on a daily basis. There we go. Fed interest rate decision. Wait, actual. Now I'm seeing estimated 0.5. This is why I like to double check different sources. Fed lifts, crap. Fed lifts rate for the first time. Let's see. An article by, it's on investing.com by Yasmin Abraham. The Federal Reserve raised interest rates Wednesday for the first time in more than 3 years and signaled a steeper rate hike path ahead to bring inflation under control. Makes sense. The Federal Open Market Committee raised its benchmark rate to a range of 0.25 to 0.5 from the 0 to 0.25 we previously had. The liftoff in rates was widely expected as Federal Reserve Chairman Powell said earlier this month that he would favor a 25 BPS rate hike at the March meeting. The start of the Fed's rate hike cycle comes as the central bank looks to step up its fight against inflation to ensure elevated price pressures don't become entrenched. Well, good luck with that. The core personal consumption expenditures price index, the Fed's preferred inflation measure, jumped 5.2% in February, and that was the biggest increase since April 1983. If you remember correctly, that was around the time that rates hit close to 20% in the 1980s. Many have argued that the central bank has left it too late to tackle inflation and now finds itself having to play catch up. I think that is a very clean and logical take on this. The Fed has kicked this rate hike just down the road for what seems like years now. We discussed this earlier, that typically they tend to raise rates when the economy is good to combat inflation, to put a roaring economy on some chains or keep it under control. And that was simply not the case since 2008. They did very slightly raise rates, and 2020 rolled in and surprised everyone, and they had to, or were incentivized to push them back down to zero. So the problem is rates never really recovered. This is likely a first for the United States, if I'm not correct or not mistaken. This is probably the first time we've seen this situation where the economy seems to be a little uncertain, a little skeptical. Oh, there we go. Bitcoin just tested the daily bullish engulf line at 39,675. Let's see if we get a bounce. I'll get rid of this. And so we're a little bit in uncharted territory. Little uncharted territory. How's this going to play out without rates ever recovering? The Fed backed into a corner here. So raising rates seems to be the only option they have, or at least the one they're employing. Powell clearly understands that the Fed is going to really have to focus on inflation now that it's gone far beyond their expectations. Funny side note, you guys remember, if you've watched them here, because we've watched almost all of them, the Fed started with there isn't inflation. Then they started with there's inflation, but it's transitory, suggesting that it's only short term. Now inflation is beyond their expectations. Every time we watch one of these, I make kind of the same point, is what they say is so unimportant. I mean, it's important in some ways, but literally unimportant, because they're always doing like a little sleight of hand trick where they're saying, look here, and it's always the opposite. Inflation, turns out it did exist, it wasn't transitory, and now they're taking action to combat it. Inflation is definitely not something that you can fight in a short time period. This takes time for it to trickle through the economy, and I hope that this is timely enough. I really do. Bitcoin finding a little support, it looks like, on the 5-minute here, pulled up from that daily bullish engulf line that we just placed. Good timing. Good timing. Really want to see it hold that into the close. We'll see what happens. So we've got about, 20 minutes. 20 minutes till they're actually live here. Let's see if they've started up anything. They've got their own terrible music playing. Boo. It is playing. So what are you guys saying? Heard they will increase the rates. They did. They increased the rates. It's officials. They increased them as they stated they would, 25 basis points. So interest rates are now 0.25 to 0.5%. These are still historically extremely low. I think the big takeaway from the language that I've seen, and I'll admit I've only seen 1 or 2 articles so far, is that they're looking to crank up the aggressiveness of these. And we'll find out when he talks, and that, like I said, will be in like 20 minutes. We're going to have that live here. But when he talks, what I like to do is really read into the way he says something, what words he uses, what tone that they use. And I also enjoy watching them dodge the questions. You'll notice when they go to the questions part at the end that they never answer any questions. They'll ask a question. I don't even know why they do it, but they ask a question and they're like, and they just regurgitate something that they said earlier. There's never any new information, but they're fun to watch. And I kind of like interpreting how nervous they are at the questions. So those are always good little fun tidbits here. Is there any other articles coming out? Wall Street urges Ukraine peace talks as Fed decisions eyed. How's that related? All systems go for Fed's liftoff of U.S. interest rates. You have another article that is out by Reuters. Wait, this is 4 hours ago. Did they know? Insider information. Why does this say it's a new article if it was released 4 hours ago? Nope, not a new article. Any other stuff coming out? Where are the good articles? Who writes good articles? I like investing.com, but not always the most timely. Fed rate hike. Fed rate hike. Anytime. Past hour. All right, USA Today, the Wall Street Journal, Spectrum News. All right. See if there's anything new, anything of value here. I guess a good reminder, they're projected to have 5 to 7 rate hikes this year. So in the next 3 quarters, because March is wrapping up, we're expecting 5 to 7 more of these. That is a pretty aggressive stance. We really saw them be very reluctant to lower these rates. It took them a long time. They left them at 0 to 0.25% for a long time. And it's going to be interesting to see how the market reacts to what looks like now an aggressive rate schedule. Americans will soon see higher rates on everything from credit cards to mortgages. So I guess that's something I did talk about. Credit cards, mortgages are probably a good point here. While the Fed rate, what was changed today, is reflective of bank-to-bank lending, it does spill over into the consumer markets, or into consumer debts and interests like credit cards, mortgages. So this will have a direct impact, it seems, on most people. I guess they're speculating they'll also see rates rise on some bank savings accounts and CDs. Who cares? It's 0. My bank pays me 0. It's like 0.003 or something. To see that move up to like 0.01, who cares? But I don't know, maybe someone does. Let's see, another article. The Wall Street Journal reports the Federal Reserve raised its benchmark interest rates for the first time since 2018. They all seem to be saying the exact same language. The central bank is navigating an unusually complicated environment of tight labor markets, supply disruptions, spiraling inflation, and now Russia's invasion of Ukraine, which has clouded the outlook and worsened price supply chain pressures that many had hoped would soon ease. That was like not even an article. Thanks, guy. I guess what we could do is let's peek in. Let's see if stocks are reacting the same. Let's see if the S&P 500's moving. Wait, clean this up. Take a look here. Yes, that's from a long time ago. There we go. Well, the day is red, it does seem. Is this on the news? Okay, 1, 2, 3. About 4 hours ago, it looks like the S&P, it's probably a daily high. Hit a daily high, and for the last one too. I'll say the last 4 hours has been selling off, so market's not super bullish on this news. Not really news, but what we do see is there was a gap on the open on Monday, and this does look like it's kind of just coming back to fill that gap. So at the moment, the S&P is not looking awful in the super zoomed in short term, but the longer term picture, as you can see, we looked at recently, this is not a super healthy chart. I'm glad Bitcoin doesn't look like this. Glad Bitcoin doesn't look like that. What an ugly chart. What an ugly chart. We can look at a neckline. We can say, hey, right here is a neckline, about 4,500. Tested it twice, double topped, sold off, and now we've really regressed back to this mean trend that we identified. It's been wild, guys. I just, for all of you that have been here, we're coming up on 3 years of streaming in May. That's right, 3 years of Tom Crown. What the? No one expected that. And it's awesome to me to be able to open up charts that I looked at years ago. So this one was almost 2 years ago now, we were looking at this and saying, oh, we have a little trend line here. And now 2 years later, we're seeing price interact with that trend line again. That's wild. Thank you all for sticking around. And thank you all that are new here. Thank you as well. It's great to have our fam growing. We broke 54,000 subscribers this year. We had Kevin O'Leary. Been a journey. Thanks, guys. For anyone tuning in for the first time, welcome. Please smash the like button and subscribe. We do lives here almost every single day. Might as well. The better part of every single day. Cheers. Vincent Guerrero. Tom said Litecoin AK, make it happen. Stop playing with our emotions. In time, Vincent. In time. I haven't changed, guys. I know that the markets have been a little choppy seas, right? Choppy seas. We've been going sideways on Bitcoin for a year. I'm still streaming the same prices. Oh my God. But in the past, you guys have heard me make bull cycle top predictions, targets. Nothing has changed. This is a great time to bring this up. Nothing has changed for me. In my eyes, I know that sentiment is very low. It's very reminiscent, actually, of some of the lowest times in the Bitcoin history I can remember. But I have not changed my opinion. I still think Bitcoin's going to 300. What was my number? 366. 300. I think it's going to 300 plus $1,000. I will admit the timing. Did not get the timing right. I think that's obvious. I'm just pulling up like gold here. Gold, same thing. Looks like markets in general across the board red for the day. Look at the dollar. Timing, I was definitely not right. So you guys know, keep me honest. I was expecting $100,000 by last year in January or July 21st. $100,000 on Bitcoin. That seems foolish now, right? Looking back, it's like, haha, you're so dumb. But I started saying this in 2019. So at one point it was brilliant as we rallied to 69,000, and then at another point, you know, in the hindsight now, it seems foolish. That's kind of the telltale of cryptocurrency. It's like name a number, name a target. It can look, it can be sound like the stupidest thing today, and it can be the most obvious thing tomorrow. That's a good learning lesson. It does look, I'm pulling up the dollar here, the Dixie. Looks like pretty much the only thing green today, and if we zoom in on this candle, we can see this is basically a spinning top doji. This is virtually where the dollar opened today after trading to, looks like a new weekly low. Dollar's back to where it opened at 89.89. We're yet to break that 100 mark on the Dixie. And that might be spicy if we do. I'd like to, honestly, I'd like to see it. We already got to like 99.4. Let's go to 100. It'd just be a nice clean number. If we don't get there, I'll be so disappointed. My OCD will rage, will burn with fire. Man, gold is actually really dumping. Bitcoin, let's be realistic. Bitcoin's very neutral on this so far. Not much has happened. We had that little like 5-minute spooky red candle dump, but we're just back to where we're ranging. That's really a nothing burger move. Gold, on the other hand, this is looking a little spicier. We can see gold is very unhappy off this news. Not only has it been dumping up to this FOMC meeting, it's picking up that dumping pace literally at the publish. So I think this puts it in good perspective. We look at gold since, I don't know, what, the 8th. This has just been selling. On the announcement, boom, you get a harder sell candle. If you look at Bitcoin, pretty much sideways. Bitcoin honey badger does not seem to care. Yeah, there is a red candle on this hourly, but really just in the range it's been in. Nothing new for the most part there. Man, we still have 11 minutes to fill. How should we fill the next 11 minutes? I have a good idea. We can do it by liking and subscribing. Yay. Yay. That'd be cool. Do I not have my alert box on? Oh well. Your home tutor subscribed. Welcome, brother. Thanks for subscribing, my friend. Followed by There Is No Second Best, comma right, and DS. Welcome, everybody. Welcome to the fam. Wat Hansak Jimwatanakai. Man, I hope I got close to that. That was someone who subscribed. Welcome. I probably butchered it. 580 watching. D Ford. Looney, dude, I'm hoping Gina's in this meeting. Gina! I love you, Gina. What's up, Ultra Sith, Mr. Techno Goody? Did I see the recent Elon tweet? Elana, comical. Andy Lee. I don't know. I follow Elon, but he doesn't always come up on my feed. He's a shit poster. Let's see what he posted. Did you guys see what he named his new daughter? Oh my god. He should not be allowed to name humans. Can we all agree? Can we vote to remove Elon's Musk? Well, I guess it's Elana Musk's. Wow. Okay. Let's show you guys what I'm talking about here. What? Okay. Apparently, Elon Musk has renamed himself to Elana Musk on Twitter. He is repping some badass shades, so I'll give him some props there for imitating the Crown style. I'm not does anyone know why he changed his name to Elana Musk? That just seems really random. Is there a reason? I don't get it. I'll leave this up. I don't understand Elon. I want to like Elon. I used to love Elon. Then I kind of hated him when the whole Doge thing started, and now I just am confused by him. Like, what goes through that man's mind? I guess it's when you have hundreds of millions of dollars, it pollutes your thoughts a little bit. The Chechenian military leader called him Elana. Okay. All right, that's kind of cool then. That's kind of like ballsy. Like, someone makes fun of you, and as a person in the public eye, not like Elon, but being a streamer, I'm used to the heckling, and I'll say, man, like, that's how you deal with it. When someone heckles you, you just gotta own it, and then you take away all their power. Billions. Oh yeah, you're right. You're right. Billions and billions. Hundreds of, well, hey guys, hundreds of millions adds up to billions, so technically everybody's right. What's up, Gotsum? He's a puppet. Is he? I don't know. Probably. I'm not the rich elite, so I don't really know. Intelligent people like Elon are out there. I certainly would never say that Elon isn't intelligent. That I would not say. Dr. MC Hano Matha Raju. What's your opinion on BTC? BTC seems pretty unimpressed. You know, the Fed rate was scheduled. They didn't deviate from the plan. Bitcoin just seems unimpressed. It's no movement. Right before, literally minutes before the notes were released, we looked at the daily chart. I'll pull it back up. Looked at the daily chart and we said, hey, this doesn't look so terrible. This isn't the worst. I'll make this big again. This isn't the worst. It might be hard to see. There we go. This isn't the worst. We certainly, price was a little higher when we looked at this. Definitely was a little higher. But basically, we pointed out we have a potential 3-candle trade setup. This is like a pattern. I'm not saying to do this. I don't give financial advice. But this is what the pattern is called. And that would be valid if the daily can close above 39.6. And basically, to put this in simple terms, what that 3-candle trade setup pattern is one big candle. This can be in reverse as well, but I'm just going to give the bullish scenario because that's what we're looking at. So one big green candle followed by a small bodied red candle, and the confirmation, air quotes confirmation, is when the next daily candle closes bullish engulfed. So that's why we've identified 39.6, a close today, will set us up with a very bullish pattern. It looked a lot better when we first did it because price, like a magnet, just like a magnet, flew down to that daily bullish engulf level we've seen in the last 20 minutes. That tested 3 times. It did find buyers, but we're really not seeing strength quite yet. I'm not seeing strength quite yet, but in the bigger scheme, it's like nothing has happened. Like this, sure, this could dump down or it could get bought up and fly up, but at the moment, it's very much just in this range that we've been in. You can look back all the way to January 20th. We can even say farther back. January 5th. So the entire year. We have really traded between 44 and 32. That's a pretty big range. But as time has progressed, we've seen the lows come down. The lows move up. The highs come down. And we're really seeing like a symmetrical pattern paint. And we haven't seen it broken. The move to the upside here didn't break that. And this corresponding dump afterwards didn't invalidate it either. At this point, price would have to trade below like 37.5, and then maybe you're looking at the pattern a little broken, but you'd have to go lower. You'd go down like 34, under 34, and we can say, well, it's probably broken out of this symmetrical pattern. So far, just nothing. So far, this has been the most boring trading ever. As someone who streams Bitcoin price action, I have not had a lot of content to work with lately. It's been rough. But you know how you can make it better? Smash that like button. That's right. Caught you. You can make my day a little better. We have 600 watching and not even 300 likes. We can get 420 likes with your help. If we get 420 likes, I get to keep my 420 license for another day. And you guys don't want to see me without my 420 license. I'm not friendly. What's up, Big Tuna Crypto? Let's go, bruh. Gina. Kevin, can you get Gina on the line? Can anybody get Gina on the line? I need her on the stream with me while we watch this. Please. We have 600 people. Someone here has to know Gina. Somebody. Frederico R. Self High Five. R Lake. Johnny G. Anybody? Mr. Jake the Snake. That wick is bearish. Be careful. It certainly wasn't bullish. I do like where it stopped. In fact, I like where it stopped so much I'll put another alert. Anything above 39.6 today is a good close. Can you let us know what time the FOC meeting is? Well, it does say it right there, but the actual meeting. So the notes were released. 25 basis points confirmed. So on schedule. The speech or the live stream is in 3 minutes, and we're gonna watch it right here. You're gonna see it right there. When they go live, that's gonna change. We're going to watch the Bitcoin chart as we do during these lives. It's fun to see it react in real time because sometimes they'll say something and you'll just see the candle fly up or fly down. And it's fun to think like kind of people are voting with their coin in that way. What's up, Trevor? Molly Knox? Molly Knox? Chandra Secker? Thanks for subscribing, guys. Anyone else out there? I'm going to shut up a little more during the actual speech, so I got to get it out of the way now. If you haven't subscribed yet, please subscribe and enable notifications. Smash the like button. We do live streaming here on YouTube almost every day. Better part of every day. I think in the last 30 days we've published like 25 or 26 videos or live streams. It means a lot, and the more people who subscribe and like during the live stream, the more YouTube shows our channel and our videos to new people, so helping out. I appreciate it. Crypto Poppy, showing up with no notes. Showing up with no notes. Guys, you do not want to leave now. This is literally starting in 1 minute. We got 1 minute, and then I'll shut up. Or I'll be goofy. And we'll put it to a poll. During the Tom should be there we go. Vote silly or serious. If you just want me to shut up and be serious while it's on, I'll do that. If you want me to be silly, I like being silly. I like to spice it up. Just hit the notification bell. Tyler Wortham, you're the man. What's up, CNC Ireland? My home country, Ireland. TLDR, dollar broke, Band-Aid applied. Turns out Band-Aids don't fix situations. It's the natural immunity defense system of the body, not the Band-Aid. The dollar is pretty much the only thing green at the moment for the daily. I'm keeping tabs on it back here. I need to get rid of this one chart though. This one Dixie chart is super annoying to me. I'm just gonna like this one. There you go. Dollar, only thing green. We looked at commodities. We looked at indexes. Obviously, looking at Bitcoin. Everything pretty red on this news. Not catastrophically red, but down on the announcement. The dollar really seeming to be the only thing that is up on the announcement. And I think any second now this should start. Any second now. Also, real quick shill, before it starts, join the Discord. Discord link is in the chat. All you have to do, jump in there, verify. You'll be able to see a verify room. Just click the green checkmark emoji. That's it. Just keeps the bots out and the scammers out. But join Discord because after the live, we're going to do as we always do. We're going to airdrop some coins on you. And all you have to do is be in the Discord to receive that. And you'll get all the airdrops as long as you stay in there. So jump in there. It's free. There's educational resources. But really, it's the best way to keep up with the community and our content. So let's go. Where's Powell? Powell is late. He's late by a few seconds. I'm angered. I'm going to go ahead and refresh this page just to make sure.
Given us.
There we go.
Maximum employment and price stability. Today, in support of these goals, the FOMC raised its policy interest rate by 1/4 percentage point. The economy is very strong, and against the backdrop of an extremely tight labor market and high inflation, the committee anticipates that ongoing increases in the target range for the federal funds rate will be appropriate. In addition, we expect to begin reducing the size of our balance sheet at a coming meeting. Economic activity expanded at a robust 5.5% pace last year, reflecting progress on vaccinations and the reopening of the economy, fiscal and monetary policy support, and the healthy financial positions of households and businesses. The rapid spread of the Omicron variant led to some slowing in economic activity early this year, but cases have declined sharply since mid-January, and the slowdown seems to have been mild and brief. Although the invasion of Ukraine and related events represent a downside risk to the outlook for economic activity, FOMC participants continue to foresee solid growth. As shown in our summary of economic projections, the median projection for real GDP growth stands at 2.8% this year, 2.2% next year, and 2% in 2024. The labor market has continued to strengthen and is extremely tight. Over the first 2 months of the year, employment rose by more than 1 million jobs. In February, the unemployment rate hit a post-pandemic low of 3.8%, a bit below the median of committee participants' estimates of its longer-run normal level. The improvements in labor market conditions have been widespread, including for workers at the lower end of the wage distribution, as well as for African Americans and Hispanics. Labor demand is very strong, and while labor force participation has increased somewhat, labor supply remains subdued. As a result, employers are having difficulties filling job openings, and wages are rising at their fastest pace in many years. FOMC participants expect the labor market to remain strong, with the median projection for the unemployment rate declining to 3.5% by the end of this year and remaining near that level thereafter. Inflation remains well above our longer-run goal of 2%. Aggregate demand is strong, and bottlenecks and supply constraints are limiting how quickly production can respond. These supply disruptions have been larger and longer lasting than anticipated, exacerbated by waves of the virus here and abroad, and price pressures have spread to a broader range of goods and services. Additionally, higher energy prices are driving up overall inflation. The surge in prices of crude oil and other commodities that resulted from Russia's invasion of Ukraine will put additional upward pressure on near-term inflation here at home. We understand that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation. We know that the best thing we can do to support a strong labor market is to promote along expansion, and that is only possible in an environment of price stability.
Sure, pal.
As we emphasize in our policy statement, with appropriate firming in the stance of monetary policy, we expect inflation to return to 2% while the labor market remains strong. That said, inflation is likely to take longer to return to our price stability goal than previously expected. The median inflation projection of FOMC participants is 4.3% this year and falls to 2.7% next year and 2.3% in 2024. This trajectory is notably higher than projected in December, and participants continue to see risks as weighted to the upside. The Fed's monetary policy actions have been guided by our mandate to promote maximum employment and stable prices for the American people. Our policy has been adapting to the evolving economic environment, and it will continue to do so. As I noted, the committee raised the target range for the federal funds rate by 1/4 percentage point and anticipates that ongoing increases in the target range will be appropriate. The median projection for the appropriate level of the federal funds rate is 1.9% at the end of this year, a full percentage point higher than projected in December. Over the following 2 years, the median projection is 2.8%, somewhat higher than the median estimate of its longer-run value. Of course, these projections do not represent a committee decision or plan, and no one knows with any certainty where the economy will be a year or more from now. Reducing the size of our balance sheet will also play an important role in firming the stance of monetary policy. At our meeting that wrapped up today, the committee made good progress on a plan for reducing our securities holdings, and we expect to announce the beginning of balance sheet reduction at a coming meeting. In making decisions about interest rates and the balance sheet, we will be mindful of the broader context in markets and in the economy, and we will use our tools to support financial and macroeconomic stability. As we noted in our policy statement, the implications of Russia's invasion of Ukraine for the U.S. economy are highly uncertain. In addition to the direct effects from higher global oil and commodity prices, the invasion and related events may restrain economic activity abroad and further disrupt supply chains, which would create spillovers to the U.S. economy through trade and other channels. The volatility in the financial markets, particularly if sustained, could also act to tighten credit conditions and affect the real economy. Making appropriate monetary policy in this environment requires a recognition that the economy often evolves in unexpected ways. We will need to be nimble in responding to incoming data and the evolving outlook, and we will strive to avoid adding uncertainty to what is already an extraordinarily challenging and uncertain moment. We are attentive to the risks of potential further upward pressure on inflation and inflation expectations. The committee is determined to take the measures necessary to restore price stability. The American economy is very strong and well positioned to handle tighter monetary policy. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
He does not. He does not look forward to him.
Let's go
Gina?
to Gina at the New York Times.
Yes. Let's go, Gina.
Thank you so much for taking our questions. I
Looking
wonder
good,
if you
baby.
could detail your thinking a little bit about how you're considering the risks of going too fast and potentially tipping the economy into recession, and how you're weighing those risks against the possibility of going too slowly, allowing inflation to become embedded and kind of getting behind the curve.
Everybody shut up. Gina's talking.
I guess I would start by saying that, in my view, the probability of a recession within the next year is not particularly elevated. And why do I say that?
Great question, Gina.
Aggregate demand is
Beautiful
currently
question.
strong, and most forecasters expect it to remain so. If you look at the labor market, also very strong. Conditions are tight, and payroll job growth is continuing at very high levels. Household and business balance sheets are strong. And so all signs are that this is a strong economy, indeed one that will be able to flourish, not to say withstand, but certainly flourish as well in the face of less accommodative monetary policy. So
Gina talk,
I guess that's
green
how
candle.
I would say I'm looking at that. Of course,
Gina talk, green candle. Powell talk, red candle.
Sustaining a strong labor market, and that is. But we do feel the economy is very strong and well positioned to withstand tighter monetary policy.
Chair Powell, I have a question, Chair Powell.
Thank you. Let's go to Howard.
No, go back to Gina.
Hi, Chair Powell. I was wondering, in the SEPs, you have quite a markdown to GDP from 4 to 2.8%. I'm wondering, how much of that do you feel is a result of the Fed's stiffer than expected action here? You talk about monetary policy operating with a lag, but is this going to bite quicker than expected?
I don't think that's a big piece of it, actually. I think some of that is just an early assessment of the effects of spillovers from the war in Eastern Europe, which will hit our economy through a number of channels. Highly uncertain, but you're looking at higher oil prices, higher commodity prices. It'll be
higher Bitcoin.
So that we think that will weigh on GP to some extent. So that's part of what moved those assessments down. I think generally monetary policy works with a lag, so some of that would also be in there. But remember as well that 2.8% is still very strong growth. If we think that the potential growth rate of the economy is somewhere around 1.75%, 2.8% is strong economic growth. It would have been one of the strongest years, in fact, of the last expansion. So while it's lower than last year's 5.8%, it's still quite strong growth. So I would say it's quite a strong forecast.
So in that context, what would trigger you to go faster or slower on the rate hikes? Ongoing increases doesn't really tell us whether this is going to come into or evenly paced.
Fair question.
Yeah, so the way we're thinking about this is that every meeting is a live meeting, and we're going to be looking at evolving conditions. And if we do conclude that it would be appropriate to move more quickly to remove accommodation, then we'll do so. I can't be perfectly specific about it, but that's
Dollar
certainly a possibility as we go through the year.
Thank you.
Thank you. Let's go to Rachel at the Washington Post.
Chair Powell, can we get Gina, Chair Powell?
Thank you, Michelle, and thank you, Chair Powell, for taking our questions. I'm curious if you can be specific on when you expect to see inflation will start to come down, especially with the combination of rates going up, fiscal aid dissipating from the economy, and supply chains getting better. And if you don't start to see that, how will you signal it? What will you be looking for, and what will you be looking for over the course of the year? Thank you.
So I guess I would say that before the invasion of Ukraine by Russia, so let's go back to that. I would have said that the expectation was that in the first quarter, maybe the end of the first quarter of this year.
They got to upgrade their connection at the Fed.
And then maybe stay at that level or a little bit lower and then start to come down in the back half of the year. So now we're already seeing a little bit of short-term upward pressure in inflation due to higher oil prices, not natural gas a little bit, but not so much for us since we have our own natural gas supply, other commodities prices. The other thing is that you're seeing supply chain issues around shipping and around lots of countries and companies and people not wanting to touch Russian goods. So that's going to be more tangled supply chains. So that could actually push out the relief we were expecting on supply chains generally. So I guess I would say that the expectation is still that inflation will begin to come down in the second half of the year. But if you look at where I read the SEP headline median, we still expect inflation to be high this year, lower than last year. And then we expect, though, particularly with the effects of the war, but also the data we've seen so far this year, we expect inflation to remain high through the middle of the year, begin to come down, and then come down more sharply next year.
Get Gina back.
Let's go to Nick at the Wall
So
Street
far,
Journal.
he said nothing. They keep asking about a schedule. He keeps not giving them a schedule.
Chair Powell, over the last 6 months, the Fed has shifted its policy stance quite a bit. 6 months ago, you were still buying assets. Most officials weren't projecting any interest rate increases this year. And yet, despite the shift over the last 6 months, real rates are as negative today as they were then. So how concerned are you that further inflation surprises will offset the effects of recent policy firming by leading real rates to stay at levels that do not actually provide much restraint to the economy? Thanks.
So that's one of many ways of capturing the situation, which is that the committee really does understand that the time for rate increases and for shrinking the balance sheet has come. And I would just say, I would go back to the economy is very strong. As I mentioned, tremendous momentum in the labor market. We expect growth to continue. It's clearly time to raise interest rates and begin the balance sheet shrinkage. And I just wanted to say that as I looked around the table at today's meeting, I saw a committee that's acutely aware of the need to return the economy to price stability and determined to use our tools to do exactly that. You couched it in terms of real rates. I would say if you look at the SEP, you've got people getting close to or even above, in many cases, their estimate of the longer run neutral rate. So I understand that doesn't do it for real rates, but if you go out a year or two, many people are in their forecasts are having tight policy from a real interest rate standpoint. So that's something that we're focused on. Of course, it's a highly uncertain environment, and we don't know what's going to happen, but we do know that we're going to deploy our tools to achieve our goals, and that includes the price stability goal.
Gina?
Let's go to
Gina,
Victoria.
questions
at
for
Politico.
Chair Powell? Gina?
Hi, Chair Powell. So
Chair Powell.
looking at the summary of economic projections, you all have inflation coming down over the course of the year to 4.3%. And then you also have rates going up to what appears to still be below roughly what would be estimated to be the neutral rate, although I know that's a little bit uncertain. So I was just wondering, how much of inflation coming down do you see as actually being as a result of the Fed itself raising rates? And then also, if I could just ask, given that Sarah Bloom Raskin withdrew her nomination, what do you expect to do with the regulatory portfolio? Do you expect to assign a governor?
Stocks bouncing, gold bouncing.
Okay.
Dollar losing some of its gains.
Tell me again your first question.
My first question is, how much do you expect inflation to come down as a direct result of the Fed's actions this year?
Chair Powell.
Okay, so part of inflation coming down at the very beginning is clearly to do with factors other than our policy, and those would include potentially the supply chains getting a little bit better. Certainly, base effects. You're lapping, as you know, when you look at a 12-month trailing window, you're lapping very high inflation in March, April, May, June of last year. So there should be some effects from that in the 12-month picture. Really, what we're looking for, though, is month-by-month inflation coming down, and so it's really it's all the things we've been talking about, that really haven't helped much, including the shift away from goods and back to services, including supply chains getting better, including labor force participation, all those things that have been sticky and we started talking about rate increases last year for some months now. Financial conditions have already incorporated a significant number of rate increases. So it doesn't start today. In effect, the moves are already priced into the market for a few months now. So
You were saying that?
So the clock is running on that, and I think some of that will be seen in half of the year as well. So the clock is running on that, and I think some of that will be seen in half of the year as well.
What is up with their connection?
And on the regulatory portfolio, so I would just say this: we have an obligation to carry out under the law, in supervision and regulation, and we're doing that. That's what we're doing. The committee is not active, so what's happening is things are coming to the full board, and we're voting on them. We're getting our business done. We got the stress tests done. We've looked at a number of proposals for mergers and things like that. So we're working ahead. Of course, we don't have a vice chair for supervision, as you mentioned, but we're making do with the situation we have, and a good number of things have come straight to the board for approval.
Proof he is a cyborg. True.
Let's go to Neil Irwin at Axios. Let's go to Neil
Look at how
Irwin.
many people are disconnected.
Hi, Chair Powell. It's Neil Irwin at Axios. Thanks for taking our questions. In the statement of economic projections, we see a forecast of median 1.9% Fed fund rate at the end of the year, 2.8 end of next year. Wondered whether that aligns with your own expectations, in particular on that point of overshooting the long-term neutral rate. And also, if you can tell us anything about how that might be paced, front-loaded, back-loaded, how high is the bar for doing 50 at one meeting?
So I don't, Neil. I've never talked about my own SCP projection. It's in there, but I think Fed chairs have generally not done that because we just haven't done it. It's because we have to put together the consensus on the committee and present that consensus. So I wouldn't talk about my individual one. And in terms of the pacing of it, I would just point out that there's 7 remaining meetings this year. This isn't something we discuss or debate or agree on, but there's 7 remaining meetings and there's 7 rate hikes. I would add there's also the shrinkage of the balance sheet, which people do the math different ways, but that might be the equivalent of another rate increase just from the runoff of the balance sheet. So I don't know. We haven't made any decisions on front end loading or going steadily through the year. And as I mentioned,
He won't answer.
If you look at the SEP, a good number of participants do see more than 7 rate increases this year. And I can't give you, I'm not going to try to give you a really specific test for what it would take to do that, but I will say this, though, we'll be looking at the data as they come in. We'll be looking to see whether the data show expected improvement on inflation. We'll be looking at the inflation outlook and making a judgment. And we'll be going, each meeting is a live meeting, and if we conclude that it would be appropriate to raise interest rates more quickly, then we'll do so.
What? What? Someone was trying to say it was my connection. Their router just popped up. Play it off. Tripal? What was that, Tripal? And was that part of the Fed statement, Tripal? Mr. Tripal, you seem very quiet. Mr. Tripal, wake up. Coochie, got your belly. Got your belly. He is a robot. I think this is proof he is a robot. He is just standing there. He's not saying anything. The stream isn't frozen.
1 second.
There we go. Someone needs to reboot him. Have you tried turning him on and off again?
Okay, we're going to try one more time. Colby Smith at the FT.
Gina? Mr. Tripal, are you stuck? Are you stuck? Mr. Tripal. He's at a loss for words. So they keep asking him.
We'll come back to Colby. Let's go to Edward Lawrence.
They keep asking him when
Thank you, Chair Powell. Thank you, Michelle, for the question. I have a more basic question. The last time the CPI inflation, I know you look at PCE, but CPI inflation was as high as it was July of 1981 when the effective federal funds rate was 19.2%. But given the current data, how far behind the curve of inflation do you believe the Federal Reserve is in your mind?
Incoming vague answer.
I just would say a couple of things. We have the tools that we need.
Not answering the question.
And as you can see, we have a plan over the course of this year to raise interest rates steadily and also to run off the balance sheet. High inflation does not become entrenched while also supporting.
Dude, they're having the worst
And
problems
as
with
I
the
mentioned,
stream.
if we conclude that it would be appropriate to move more quickly, we'll do so. I'll leave it to others to make the judgment you ask for.
And then just as a follow on that, I wanted to get you on the record on this. What impact has there been on your job, given the fact that you...
This is their What's happening? This never happens. What is going on? That's all on them. I'm glad it isn't full screened.
Edward, can you repeat that question?
They need a little help from me. Setting up their stream, it seems.
That given you're not actually confirmed and Governor Brainerd is not actually confirmed, has there been any impact on your job or the Fed's ability to handle inflation?
None whatsoever.
Someone keeps alt-tabbing it accidentally.
Let's go to Colby Smith at
These
the
are the
FT.
people controlling the monetary
Thank you, Michelle.
policy of the
Chair
United
Powell
States.
concerned the committee about the notable pickup in services inflation,
Chair
which is
Powell.
perhaps less likely to self-correct. And to what extent does it alter both the committee's long-term inflation expectations will not de-anchor in the coming month in the dot plot? Thank you.
Chair Powell.
Thank you. So,
Thank you.
of course, that's something we're watching report by report, and we noticed it in the last meeting, and it's part of the overall picture. We have expected services inflation to move back up to where it was, and that's part of what's happening is, in the case of some services, prices are still getting back up to where they were before the crisis. In other cases, it's pretty clear that inflation has spread more broadly across services, and yes, that is concerning. In the meanwhile, we see some progress on the goods side, but really in this latest report, it was confined to vehicles, which is admittedly a large category. So, as I mentioned, the committee acutely feels its obligation to move to make sure that we restore price stability, and is determined to use its tools to do so.
And Chair Powell, when moon, Chair Powell.
Thank you. Let's go to Steve Leisman at CNBC.
Everything's bouncing.
Thank you.
Nope.
Let's go to Steve
That was a
Leisman
great
at
question. Thank you.
CNBC.
That was a great question.
Mr. Chairman, I wonder if
You can
could
see the
help me
Mac OS
understand the
stuff.
kind of logic, if there is one, inside the SCP here. As I look at the median forecast, for example, for unemployment, it runs for the 3-year window below the rate.
This is a straight up shit show. What is happening? Cisco websites, Cisco routers.
3-year window, the long run, or call it the neutral rate.
Bring Gina back.
And that is all true in a regime when you run, at least for 2 years, the funds rate above the long run rate.
Hey, they're on a 56K modem.
This, are you not give a forecast here that essentially suggests you will be continuing to run further behind the curve and never really get in front of inflation because the economy will continue to run hot? And kind of on a related issue, you said earlier, inflation will take longer to return to price stability than we had originally expected. Isn't that a choice you're making? And if so, why are you making that choice to let inflation run above price stability longer than you'd like?
Great
Right,
question.
so
Next question.
If you look, first of all, you're looking at medians, but understand that it's not something we voted on. It's not a plan. But if you look, people do have their by the end of this year, broadly, people are at or close to, or in some cases above, their estimates of longer run neutral interest rate. Okay, so that should stop pushing. That should, in other words, that should be a removal of accommodation for monetary policy, basically. At the same time, we will have done significant balance sheet runoff, and you can think of that as further. In the next year, and just looking at the median, you're now above above the what people estimate to be the longer run median. So and also in many people's forecasts, that actually amounts to tight policy in real rates as well. So why does unemployment remain at 3.5%? A couple points. One
Because
is
you
the
touch yourself at
connection
night.
between in the economy we had before the pandemic, the connection between inflation and the level of the unemployment rate was not very tight. But this is clearly what this is an expectation that really it amounts to the idea that wage increases, which are now running above the level that would be consistent over the long run with 2% inflation, will move back down to levels which are still very attractive, full economy full employment kind of
Just
wages.
what we need,
but
lower wages. Thanks, Pat.
Not to a point where they're pushing up inflation anymore. And as I mentioned, there are a lot of factors causing inflation to come down. And the reality is there are many moving pieces, and we don't know what will actually happen. But no matter what happens, this is a committee that is determined to use its tools to make sure that higher inflation does not become entrenched. And so we are determined on that front, and we'll deal with what comes. this is a modal or most likely expectation, but we'll deal with what comes, whether it's
Everything
better or
they've
worse.
said about inflation has been wrong. It's not here. It's transitory. Everything is wrong.
Thank you. Let's go to
Why
Chris
would we-
Rugaber at the
Why would
AP.
anyone believe this now? They can't even get a stream
Hi,
right.
thank you. Well, let me follow up a bit
Ooh,
on
who's
that.
that?
I mean, there are a lot of economists skeptical
Not
that
Chris.
you can reduce inflation as much as you've penciled in without raising the unemployment rate. And I'm wondering just what are the mechanisms you see in reducing demand? I mean, outside housing and autos, how do higher Fed rates reduce consumer demand unless it's through higher unemployment? Thank you.
Well, if you take a look at today's labor market, what you have is 1.7 plus job openings for every unemployed person. So that's a very, very tight labor market.
Someone has their
Tight
audio
to
feeding
an unhealthy
back. What
level,
a
I would
shit
say.
show.
So, in principle, if let's say that our tools work about as you described, and the idea is we're trying to better align demand and supply. Let's just say in the labor market. So it would actually, if you were just moving down the number of job openings so that they were more like 1-to-1, you would have less upward pressure on wages. You would have a lot less of a labor shortage, which is going on pretty much across the economy. We're hearing from companies that they can't hire enough people. They're having a hard time hiring. So that's really the thinking there. Is these are fairly well understood channels, interest sensitive, and basically across the economy we'd like to slow demand so that it's better aligned with supply, give supply at the same time to recover, and get into a better alignment of supply and demand, and that over time should bring inflation down. And I'll say again though, we don't have a perfect crystal ball about the future, and we're prepared to use our tools as needed to restore price stability. With as I mentioned in my opening remarks, without price stability, you really can't have a sustained period of maximum employment. It's one of our most fundamental obligations is to maintain and restore, in this case, price stability. So we're very committed to that. Of course, the plan is to restore price stability while also sustaining a strong labor market. That is our intention, and we believe we can do that. But we have to restore.
We're going to stop inflation by our severe internet budget cuts. Now to NPR.
Thanks, and
Go to Scott Horsley at NPR.
This is the worst stream ever. They make me look professional.
thanks, and I think I missed some of your answer there, but I have a follow-up question on the labor force. We have seen some gains in the prime age workforce in the last few months. I wonder what you anticipate when it comes to some of the older workers as the health outlook has changed. Are we going to see more recent retirees following Tom Brady back in the workforce? And what would that mean for wages and inflation?
It's hard to say. What we saw in the last cycle was that over the course of a long, steady expansion, labor force participation outperformed expectations. And that was just it was a tight labor market, but it was nowhere near as tight as this labor market, but it was a tight labor market. And so people stayed in the labor force longer. It wasn't so much people coming back in the labor force after retirement. That's not something that happens in the aggregate very much. But so that's what was happening. And, more labor force participation is tremendously welcome. And of course, our policy does not in any way preclude that. This is a situation where wages have moved up at the highest rate in a very long time, and people are able to quit their jobs and move to better paying jobs in the same industry or different industry. So it's a really attractive labor market for people. And once, as we get past COVID, well and truly, it becomes an even more attractive one. So we hope that will lead to more labor supply. That's a good thing for the country. It's a good thing for people. And it also will, we think, help relieve some of the wage pressures that do put inflation more at risk. That last part is we'll have to see whether empirically it works out that way. But in principle, it ought to help with inflation as well. It's not the only thing we're looking for, though, from inflation. We're looking for help from a number of different places, and most importantly, from our own policy.
directly from our internet budget.
Okay, let's go to Rich Miller at Bloomberg.
This is the worst one they've done. Like, the amount of problems they've had is insane.
Michelle, and thank you, Chair Powell. I'm sorry, I'm having some communication problems, so I missed some of the stuff you've said. As if this has been asked. Since the FOMC met last January, risen yield curve has flattened a lot, and even further this today, dollar is up. Is that welcome? And would you like to see more in order to achieve your goals? Thank you.
So as you know, policy works
More
through financial
Gina.
conditions. That's how it reaches the real economy, by just the mechanisms you mentioned. And remember that the financial conditions we had for the last couple of years were a function not only of very aggressive
It's a shit-nado.
appropriately so fiscal policy, but also highly accommodative monetary policy. The monetary policy settings that we put in place at the worst parts of the pandemic. So it is very appropriate to move away from those. And yes, that will lead to some tightening in financial conditions in the form of higher interest rates and just the sorts of things. We're not targeting any one or more of those things, but financial conditions generally should move to a more normal level, so that because we know the economy no longer needs or wants these very highly accommodative this stance, which, so it's time to move to a more normal setting of financial conditions, and we do that by moving monetary policy itself to more normal levels.
When you say move to a more normal setting for financial conditions,
Someone get that man out of a cave.
to me that you want financial conditions to tighten further from where we are now. Am I drawing the right inference from that?
Well, yes. So I would say we look at a broad range of financial conditions, and of course, when we tighten monetary policy, we do expect that they will adjust in sync over time with monetary policy. It's not any particular financial condition, but a broad range of financial conditions. They will reflect, to some extent, they reflect any number of things. But yes, we need our policy to transmit to the real economy, and it does so through financial conditions, which means as we tighten policy or remove accommodation so that it's at least less accommodative, that broader financial conditions will also be less accommodative.
Sure, pal. Where is Gina, and why is she not speaking?
Thank you. Just a little housekeeping note. Those of you in this call, maybe
How many goddamn people are on this call?
If so, I understand the broadcast is coming through clearly on
They can tune in. YouTube.com/TomCrown.
And now
Thank you, Michelle.
Go to Gene Young.
Appreciate that, Gene. Michelle, thank you.
Hi, Chair Powell. I wanted to ask about the balance sheet discussion you've had at this meeting. Can you give us any more details? Did you discuss whether to cap runoffs or whether to increase those caps over what period, if there were any details?
Yes, thank you for asking. So at our meeting today and yesterday, we made excellent progress toward agreeing on the parameters of a plan to shrink the balance sheet. And I'd say we're now in a position to finalize and implement that plan so that we're actually beginning runoff at a coming meeting, and that could come as soon as our next meeting in May. That's not a decision that we've made, but I would say that that's how well our discussions went in the last 2 days. So a couple things just to add. We'll be mindful of the broader financial and economic context when we make the decision on timing, and we always want to use our tools to support macroeconomic and financial stability. We want to avoid adding uncertainty to what's a highly uncertain situation already. So all of that will go into the thinking of the timing around this. In terms of the,
Sure, pal. Could you give us more vague answers, please?
I don't want to get too much into the details
sorry,
because we're literally just finalizing them. But the framework is going to look very familiar to people who are familiar with the last time we did this. But it'll be faster than the last time, and of course it's much sooner in the cycle than last time. But it will look familiar to you, and I would also say that there'll be I'm sure there'll be a more detailed discussion of our in the minutes to our meeting that come out in 3 weeks, where I expect that it will lay out pretty much the parameters of what we're looking at, which I think will look quite familiar.
Yes, I'd like to dodge that question. Next question.
Thank you. Let's go to Michael McKee at Bloomberg TV.
Please. Mr. Chairman, since September of 2020, you've been
What does he keep
operating
looking
on
at?
a monetary
He hasn't
policy
said anything.
framework that let the
There we
economy
go.
run hot to bring unemployment down. That seems to be over, but I'm wondering how you would
This
describe
guy looks like a Fox
your
newscaster.
reaction function now. What is it that the Fed is trying to do other than bring inflation down? And in other words, is it we're going to keep raising rates until it comes down to an acceptable level?
Yeah, so I want to clear one thing up again, and that is that
I won't be answering your
nothing
question.
in our new framework or in the changes that we made has caused us to wait longer to raise interest rates. What we said in the framework changes was, and this was really a reflection of what had happened for the preceding couple of decades, actually. What we said was, if we see low unemployment, high employment, but we don't see inflation, then we're not going to raise rates till we actually see inflation. That's what we said.
But you see inflation right now.
There was no sense in which if we got a burst of really high inflation, we would wait to raise rates. That's simply not in the framework.
That's literally what you did,
Quite
though.
the contrary. The
Quite the
framework is
contrary.
all about anchoring inflation expectations at 2%. So I do hear this, that the framework, we can't blame the
That's
framework.
not what
It was a sudden, unexpected burst of inflation. And then it was the reaction to it, and it was what it was. But it was not in any way caused by or related to the framework. So come to today. I think our vision on this on the committee is very, very clear. What we see is a strong labor market. We see a labor market with a lot of momentum, great job creation, and we see the underlying economy strong. Balance sheets are strong. Yes, there are threats to growth from what's going on in Eastern Europe, but nonetheless, in the base case, there's a very broad expectation of strong growth.
You suck at
But inflation is far above our target, and the help we've been expecting and other forecasters have been expecting from supply side improvement, labor force participation, bottlenecks, all those things getting better, it hasn't come. And so we're looking now to using our tools to restore price stability, and we're committed to doing that. And you see that, I think, in the summary of economic projections, and you see that in the decision we make, and you will continue to see it in the decisions we make going forward.
If I could follow up by asking, I guess what you'd call it is the Paul Volcker question. You don't think unemployment is going to rise significantly, but if it does that temper your desire to keep raising rates?
Well, the goal, of course, is to restore price stability while also sustaining a strong labor market. We have a dual mandate, and they're sort of equal. But as I said earlier, price stability is an essential goal. In fact, it's a precondition really for achieving the kind of labor market that we want, which is a strong and sustained labor market. We saw the benefits of a long expansion, a sustained labor market. It pulled people back in, and there were really no imbalances in the economy that threatened the long expansion.
No imbalances over the last 2 years. None.
It was just a completely exogenous event. So that's how we're thinking about it. We of course want to achieve price stability with a strong labor market, but we do understand also that really you can't have maximum employment for any sustained period without price stability. So we need to focus on price stability, in particularly because the labor market is so strong and the economy is so strong. We feel like the economy can handle tighter monetary policy.
Thank
I
you.
don't even
Let's
know why
go
they
to
ask
Brian
these
Chung at
questions.
Yahoo.
I just tune in for Gina. Gina, chirpow. Chirpow. Chirpow,
Thank you.
Gina.
Let's go to Brian Chung at Yahoo.
Term Powell, hopefully no tech issues here on this front.
Hey.
Wanted to ask just kind of the broad question about how
He's a
you are
YouTuber.
communicating what the Fed's doing here today
Isn't
to
he?
the average American who might not be reading the dot plots or understanding what the SCP is. How is the 25 basis point hike today and then the signaling on future Fed policy going to address the inflation that they're feeling at the stores on a daily basis?
Sure. So I guess I'd start by just assuring everyone that we're fully committed to bringing inflation back down and also sustaining the economic expansion. We do understand that these higher prices, no matter what the source, have real effects on people's well-being. And really, high inflation takes a toll on everyone, but it's really especially on people who use most of their income to buy essentials like food, housing, and transportation, where I mean, we've all seen charts that show if you're a middle-income person, you've got room to absorb some inflation. If you're at the lower end of the income spectrum, it's very hard because you're spending most of your money already on necessities, and the price is going up. So, but it's punishing for everyone. So it has been a difficult time for the economy, but we do anticipate that inflation will move back down, as I mentioned earlier.
Chirpow, excuse me. Would you say they Turk or
Jerbs? I'm
Jerbs?
confident that we'll use our tools to bring inflation down. And
they Turk or Jerbs?
You ask about rates. So the way that works, I would explain, is
here he goes. He's going to repeat himself.
Rates, that should gradually slow down demand for the interest-sensitive parts of the economy. And so what we would see is demand slowing down, but just enough so that it's better matched with supply,
more
and
stimmies.
that will bring inflation down over time. That's our plan.
There's another guy named Brian who
Thank
looks
you.
just
Let's go
like
to
him that
Jolene
is a
Kent
finance
at
YouTuber.
NBC News.
I retract it. But they Turk or Jerbs?
Hi, Chair Powell. Thank you so much for taking my question and doing this today.
Move over, Gina.
My question is a follow-up to what Brian just asked. What is your message to consumers out there who can no longer afford
Gina's still my favorite.
due to this high inflation?
They can starve.
Well,
Next
yes,
question,
indeed.
says Chirpow.
As I just said, I think we do understand very much, and we very much take to heart that it's our obligation to restore price stability. And
Jolene.
We've had price stability for a very long time, and maybe come to take it for granted. But now we see the pain. I'm old enough to remember what
you are.
Very high inflation was like, and we're strongly committed as a committee to not allowing this higher inflation to become entrenched, and to use our tools to bring inflation back.
It's
down
confirmed
to
it's entrenched. He
more
just
normal
said it
levels, which
isn't.
Our target is
Confirmed.
2% inflation. So we will do that, and I just would want people to understand that. But the way we do that is by raising interest rates and by shrinking our balance sheet, and so financial conditions will become, at the margin, less supportive of various kinds of economic activity. That will slow the economy, while also allowing the labor market to remain very strong. And the good news is the economy and the labor market are quite strong, and that means the economy, we think, can handle interest rate increases.
And as a quick follow-up to that, obviously the Federal Reserve walking this very complicated fine line, trying to avoid a recession. For the consumers out there who are worried about their jobs in a possible recession, what do you say to that?
I like Jolene.
Well, I say that our intention is to bring inflation back down to 2% while still sustaining a strong labor market, and that the economy is very strong. If you look at where forecasts are, people are forecasting growth that's strong within the context of U.S. potential economic output. And we expect that to continue. And to the extent
just like inflation
data come in different, then of course our policy will adapt. But we do believe that our policy is the appropriate one for this forecast, and we believe that we can bring down inflation. We believe that we can do so while sustaining a strong labor market. The labor market it's not strong in the ordinary sense of the word. We have not seen a labor market where there are 1.7 job openings for every unemployed person, or where there
Gold,
if you
looking
add
good. Here we go, Gold.
If you add job openings to those who are employed, that's actually substantially a larger number than the size of the workforce, than the number of people who actually count themselves as in the workforce. So this is a situation where demand is higher than supply, and when that happens, prices go up. So we need to use our tools to move supply and demand back in. We don't think we need to do this alone. There will be other factors helping that happen, but we certainly are prepared to use our tools, and we will.
Thank you.
Thank you. Let's go to Simon at
Would
The
you say that you're
Economist.
going to do incremental rate increases to combat the inflation?
Thank you, Michelle. Thank you, Chair
Yes,
Powell.
that's all I've said.
Sorry to take you away from inflation for 1 minute. May I ask about the sanctions on Russia, and specifically the freezing of the central bank assets?
Gold's
Of course, that
digging what's
raises a
going
similar
on.
risk for other sovereigns around the world and their biggest companies potentially. Any concerns about, in the long term, how this might affect the dollar's status as the preeminent global reserve currency?
Let's go gold.
And in the past couple of weeks, have
Good
you
question.
had to deliver any kinds of reassurance to other central bankers?
Let's go, Simon. Good question. First good question.
So of course, central bankers around the world are generally very, very in favor of all of these sanctions. But let me say this: sanctions are really the business of the elected government, and that's true everywhere. So, the administration and the Treasury Department in particular, and other agencies, they create these sanctions.
Correct dreams.
We're there to provide
7X,
technical
correct.
expertise, but they're not. It's not our decisions, and so I'm reluctant to comment on sanctions really much because again they're not for us. We have a
Gold
very
is
specific
pumping.
mandate, and these are really the province of elected governments, as I mentioned. So I'd have to leave it at that.
Gold is too volatile. It's there's too much
Thank
risk
you. Let's
in
go
gold.
to Nancy Marshall-Genzer at Marketplace.
Nancy.
Hi, Chair Powell. Thanks for taking the question. You've been talking a lot about rising wages, which on the one
She's
hand
green
is a
screening.
great thing, but are we possibly seeing
Respect.
the beginning of a wage price spiral?
Her audio sucks, but respect to the green screen.
So the way I would say it is this:
I'm a turtle. I like turtles.
First of all, I would agree with the premise that wages moving up is a great thing.
He laughed.
That's how the standard of
It's the
living
first time he's
rises
ever
over
laughed.
time, and generally it's driven over long periods by rising productivity. But what we have now, if you look at these the wage increases that we have, we look at we're blessed with a range of measures of wages.
Hello.
That all measure different things, but right now they're all
Let's
showing
go.
the same thing, which is that the increases, not the levels, but the increases are running at levels that are well above what would be consistent with 2% inflation, our goal, over time. And that may be, we don't know how persistent that phenomenon will be. It's very hard to say. And that's really, I think, the sense of your question about a wage price spiral is that something that's going to start happening and become entrenched in the system? We don't see that. You can see, for example, in some
Peter,
sectors that got
Prevost,
very
shut up,
high
brother. Thank you.
wage increases early on. Those wage increases look like they may have slowed down to a normal level, but it comes back to, what I'm saying here, which is there's a misalignment of demand and supply, particularly in the labor market, and that is leading to wages moving up at ways that are not consistent with 2% inflation over time. And so
Yeah, say that again.
we need to use our tools to guide inflation back down to 2%. And that would be in the context of an extraordinarily strong labor market. We think this labor market can handle, as I mentioned, tighter monetary policy.
Sure, Powell, can you
and
say
the
anything
overall
other
economy
than
can
what
as
you
well.
just said?
But yes, wages are moving up faster than is consistent with 2% inflation. But it's good to see them moving up. But it wouldn't be sustainable over too long of a period to see them moving up that much higher. And that's
Looks
because
like
of this misalignment between supply and demand. We expect to
Bitcoin,
get more
gold,
labor
stocks
supply.
all
We did
recovered
last
what they
time.
dumped
We
at the
got more
start.
than we expected during the last cycle. This time we've gotten much less than expected. So it's not easy to predict these things. But we do expect that we'll get people coming back in the labor market, particularly as COVID becomes less and less of a factor in many people's lives. Something we all
Thank God. There's the one good thing he said.
So that's how we think about it.
I can't wait for it to be summer. I'll go outside again.
The LA Times.
Don Lee.
Hi, Chair Powell.
Chair Powell.
I think you said to the Senate earlier this month that in hindsight,
Yeah, wages are up,
Fed should
guys.
have moved earlier. And
Just because
it
no
sounds
one's
like,
getting paid more doesn't mean they're not
today
up.
that you don't think that there is late. You still think that the Fed is behind the curve. How much behind the curve is it?
Right. So we are not
Turtles to all-time
we
high.
don't have the luxury
Confirmed.
of 2020 hindsight in actually implementing real-time decisions in the world. So the question is
Turtles are
the right
bullish,
question is,
or
did
they're
you make
not
the right
bullish?
decisions based on what you knew at the time? But that's not the question I was answering,
Bullish.
which is knowing what you know
That's what I was
now.
answering.
So I think if we knew now, of course, if we knew now that these supply blockages really and the inflation resulting from them in collision with very strong demand, if we knew that was what was going to happen, then in hindsight, yes, it would have been appropriate to move earlier. Obviously,
Turtles.
it would be, but again, we don't have that luxury.
Turtles.
And then, so,
Turtles.
but that's a separate question from your other question, which is behind the curve. And I
Which I
don't
also
have the
won't
luxury
answer.
of
Neither.
looking at it that way. We are we have our tools, powerful tools, and the committee is very focused on using them. We're acutely aware of the need to restore price stability while keeping a strong labor market. And what I saw today was a committee that is strongly committed to achieving price stability, in particular, and prepared to use our tools to do that. We're not going to let high inflation become entrenched. The costs of that would be too high, and we're not going to wait so long that we have to do that. No one wants to have to really put restrictive monetary policy on in order to get inflation back down. So, frankly, the need is one of getting rates back up to more neutral levels as quickly as we practicably can, and then moving beyond that if that turns out to be appropriate. And as you can see, it is appropriate in the sense to people's SEPs. They do write down levels of interest rates that are above their estimate of the longer run neutral rate. And there's also a range of estimates too, as you will see.
I totally stopped paying attention to what he was saying.
But thanks for your question.
Sure, Powell. If there's inflation, will there be
all.
inflation?
Thanks, Mr.
I
Chair.
can't answer that.
Thank you.
Goodbye, Gina. Did anybody screenshot that? It's probably all their passwords and stuff. Well, that was a really long way of saying they're going to stick to their rate schedule, which is what we saw happen today with the 25 basis points. That's what they said last month. That's what they did. Chair Powell did his classic Chair Powelling, where he doesn't answer any questions, as we did predict at the beginning of this episode. And if he did answer them, simply repeated what he had already said. So we've gained not a lot. He was asked repeatedly what the scheduling was going to be like, and to my knowledge, avoided it, really only saying that there will be 7 hikes and there are 7 remaining meetings this year. So this has been hella interesting. If we take a look at the charts real quick here. Whoa, I forgot I mixed everything up. Blue. We take a look at the charts. I think we're going to do it this way from now. I'm just going to be a floating head. Bitcoin had a little rocky start here, as right here is when the meeting started. We saw our bullish engulfing daily line briefly invalidated. And since the meeting is wrapped up, Bitcoin has regained all that it's lost. We saw similar moves on, pull these up, on gold. Gold did a little dumping, recovered what it had lost during the meeting. S&P 500, same situation. All of these daily candles were red, and now they're back to green. Crude oil, we didn't actually look at that. It wasn't that interesting. And in the inverse of how we started, remember, if you remember back all those hours ago, days ago, it seems Chair Powell started talking. The dollar was the only thing green, everything else was red, and now we've seen that inverted. The dollar now moving towards a red close on the daily, with stocks, commodities, Bitcoin, everything looking, fingers crossed, for a nice solid daily green close. So I'm your floating head. Thanks for joining us for another FOMC meeting. I hope you guys enjoyed this one. I tried not to be too silly. We'll be sillier next time. Don't forget to smash the likes and subscribe buttons. We're live here all the time. We're going to be bringing you more content, the cutting edge of cryptocurrency. I'm the floating head. Tune in next time. Crown out.